I'm wondering if you could speak some to the peak housing REIT collapse. We had invested in this REIT a while back, and now I'm just wanting to know what we need to learn from this experience. Are there things that we should have looked at that we didn't see, lessons that we can learn so that we don't end up invested in another one of these real estate deals that goes south? I know there's always that risk when we were investing, but just want to learn what we can from this experience. It seems like there was a lot of high leverage that was going on and that the investors didn't really have the first position on this REIT. And so, yeah, where we should have learned that, how we should have known it, and how we can make sure we don't end up in this situation again.
All right, let's talk about real estate in general. Let's talk about this particular investment specifically. Many real estate gurus have gone bankrupt over the years. And I talked a little bit about this in my most recent real estate newsletter last month. If you're on our real estate newsletter, you get these. You probably already read this. This message will be a bit of a repeat for you. If you don't get that, you can sign up at whitecoatinvestor.com/newsletter, and you can get this newsletter. You can get the regular monthly newsletter. You can sign up for getting blog posts in your email, whatever you want. It's your choice what you get. You can stop anytime. It's totally free, whatever. But anyway, many real estate gurus have gone bankrupt over the years. And sometimes it feels like half the authors of real estate investing books have lost it all at some point in their careers. The story is almost always the same: too much leverage. By leverage, I mean debt. Okay? People learn about leverage and they get really excited about what it can do to help them achieve financial freedom relatively quickly. They say the more leverage, the better. Other people's money. The problem with leverage is that it works both ways. Just like you can double your money by putting 20% down and having a property appreciate by 20%, you can lose your entire investment by putting 20% down and having the property drop in value by 20%. In fact, if you're investing directly in real estate, not in a syndication, not in a fund, it's possible to lose more than your entire investment. Imagine putting 20% down and then having the property value drop by 50%. You're still going to owe the entire mortgage, right? The bank's not going to take less. You can lose more than 100% of your investment in leveraged investments. Now, time heals most wounds in real estate. However, for time, aka appreciation of the property value, to heal your wounds, i.e. a drop in value or unexpected expenses, you have to actually stay in the game. And the way to stay in the real estate game is to have positive cash flow. The way to have positive cash flow is to put down more money, reducing the largest expense of real estate investing, i.e. the mortgage payment. It would be extremely rare to have negative cash flow on a paid-off rental property. Even if your property drops in value, you can just hold on to it until it goes back up in value. So long as you can still pay that mortgage payment and other expenses, either from cash flow in the property or some other source of income. However, even a doctor's income can only carry so many properties that create negative cash flow. One benefit of being a passive real estate investor, i.e. a limited partner in a syndication or a fund of syndications, is that your loss is limited to your entire investment. However, you still have your entire investment at risk. And sometimes the equity in a leveraged property goes to zero, and the equity investors are wiped out. Although rare, sometimes those higher in the capital stack, i.e. those with preferred equity or the debt investors, lose principal too. If that property is the only holding of syndication, the equity investors lose all their money. If that property is one of a dozen in a real estate fund, the result is much less catastrophic, but there's still a loss of value. And if an entire portfolio or fund is over-leveraged or poorly managed, it can all be lost. So on 2 separate occasions, I've lost most or all of the principal in a passive real estate investment. And I know some white coat investors have invested alongside me in both of those investments. It absolutely does happen. And it hurts. It hurts both psychologically and financially. Financially, obviously, it hurts because you lost the money. Psychologically, you beat yourself up because you ask yourself, well, why didn't I look at this more closely? Surely if I would have thought more about this, or if I would have dived deeper or asked better questions, I would have figured this out in advance. That's not always the case. Due diligence is important, but diversification also helps protect you from what you can't know. While neither one of these partnerships in which I've lost money is completely wrapped up, there are some preliminary lessons that can already be drawn. The first episode was a result of fraud. Basically, the sponsor, aka the operator or the manager of the syndication, violated the terms of the partnership and used the value of the apartment building owned by the partnership as collateral for a separate loan. Then he defaulted on that loan. And so the sponsor ended up going bankrupt and being criminally prosecuted. But the investors, including me, really didn't have any financial recourse. There was nowhere to go. And while the platform I bought the syndication through formed another partnership with some additional equity to try to save the deal, their current best estimate is still that I'll lose 100% of my equity in the deal. And I think that's probably going to wrap up at some point in 2024. And when it's all wrapped up, I'll do a blog post about the specifics in it. The second occasion is the one referred to by this speak pipe. This was a REIT that sponsored the White Coat Investor for a year or two up until the beginning of 2023. And while the company has been very transparent about what's going on, that doesn't really do much for the disappointed investors facing serious loss of capital, including me. One of them complained to me by email, "I'll lose a lot of money on this investment." Of course, I knew that I could suffer up to 100% loss, but I viewed it as a distant possibility, as I did when I underwent hernia surgery. The operative consent form mentioned the possibility of death, but I trusted the surgeon to keep that probability minimal. It is one thing to invest in crypto, which has no intrinsic value, just what people believe it is worth. This investment was in houses, which have intrinsic value. If they're not giving the houses away for free, then how is it possible for investors to have 100% loss? Well, as I explained above, it is possible, and actually not even that hard, to lose 100% of your investment due to leverage. This REIT is currently estimating a loss of 75 to 100% of the capital from the investment. So what happened? Well, really, it's the same old story. There wasn't enough cash flow to service the debt. The capital stack started with debt. But one problem for the REIT was that some of the debt was variable, not fixed. And as you know, interest rates went up in 2021 and 2022 about 4%. So that dramatically increased the cost of the debt. Now, after the debt in the capital stack, there was some preferred equity. However, the managers of the REIT gave the holders of the preferred equity a call option. And as rates rose, surprise, surprise, they exercised the option. And the other issue with this particular REIT was there was a fair number of assets in the REIT that were build-to-rent homes that were not yet cash-flowing assets. So that further strained the available cash flow. The cash flow coming in to the REIT was being used to pay off, this now increased interest rate. It was being used to cover the expenses of these build-to-rent homes that weren't yet cash flow positive. And then, of course, these holders of the preferred equity said, we want our money. And so they got to start prioritizing the payment of that principal back. The bottom line was that the REIT could no longer cover its operating costs from cash flow, much less service that debt and give the preferred equity holders the money back as quickly as they wanted. So it began to sell the assets. In this case, in this particular REIT, those are single-family homes. So it's been trying to sell assets to raise cash. And as you know, when you're desperate to sell, you don't get very good prices on what you're selling. And that's been the case so far as the REIT tries to sell homes quickly enough to stay in business, make the now increased debt payments, and keep the preferred equity wolf away from the door. And this hasn't all wrapped up yet and probably won't for another year, but it appears that the debt holders are probably going to get their money back. The preferred equity holders are probably going to get most or all of their money back, and the equity holders, like me, are going to lose most or even all of their money. So lessons to learn from this debacle. Well, let's split them up. First, there's lessons to learn if you're a direct real estate investor or a fund manager or a syndicator. And then there's some lessons to learn if you're a passive real estate investor, a limited partner in a deal like this. Let's do the first ones for those who are direct or fund managers. Number one, use less leverage. The way to be cash flow positive is to use less leverage. Yes, it lowers your returns, but it also lowers your risk. So instead of only putting 20% down or 25% down, maybe you put 33% down or 40% down. It just improves your cash flow, reduces your risk. And if you can't stay in the game, you're going to lose the game. Second lesson is if you're going to use variable rate debt, make sure that you can afford the worst case scenario. I'm not actually against variable rate debt, but a lot of commercial properties, not only is it variable rate, but you got to refinance it every few years. Every 3 or 4 or 5 years, you got to refinance it. That's not the same as having a 30-year fixed rate mortgage. It's dramatically more risky. So you should get a significantly lower interest rate for taking on that interest rate risk yourself. But you got to be able to handle that risk. If you can't self-insure that interest rate risk, you need to pay somebody else to run it for you. And finally, don't give call options to debt or preferred equity holders. Raise more equity, put more down, and have less leverage instead. That was certainly a major issue with this particular REIT and its current problems. All right, lessons for passive real estate investors, like I was in this deal. The number one lesson is diversify, diversify, diversify. What protects you from what you don't know, from what you can't know? Diversification, right? I invest money in stocks, I invest money in bonds, I invest money in real estate. Okay. When I invest in real estate, I spread it all over the place. So if one of these deals goes bad, it really doesn't affect my financial life all that much. That can be hard to do if there are high minimum investments in these deals, and there often are. It's not unusual for these. This particular deal, I think it was 25,000, but lots of deals are 100. I've been in deals that had a $250,000 minimum. You better have a lot of money if you're going to be able to diversify. If you got to put $250,000 into every deal, a fund's going to be more diversified, of course, than an individual syndication is. But diversification between fund managers is still important, and that's part of the reason why there's this accredited investor rule, right? You got to be an accredited investor to invest in private investments. And the idea behind being an accredited investor is twofold. One, that you can evaluate the deal on your own without the assistance of a financial advisor or accountant or attorney. And two, that you can afford to lose all the money in the deal without it really affecting your financial life in any significant way. And if those aren't true, you really shouldn't be investing in these sorts of deals. The actual requirement to be an accredited investor is purely financial, though. If you've made a couple $100,000 each of the last 2 years, or $300,000 together with your spouse, or if you have $1 million in investable assets, you're an accredited investor and you can invest in these things. I actually recommend you double those numbers and use both of them. So you have an income of at least $400,000 and investable assets of at least $2 million. I just fail to see how you can really diversify these investments if you don't have that sort of change around. Okay, lesson 2, after diversification, which is the most important one to take from this sort of an incident. Invest at the minimum amount until you know a sponsor well and have evidence that they manage their business well. The shorter their track record, the less you should be willing to invest. In this case, the minimum investment was $25,000. If that is what you limited your investment to, that's all you're going to lose. If you invested $250,000, that's the most you can lose. So until you know somebody well, and in my experience, that takes years. Maybe don't invest more than the minimum. Maybe it's the second deal that you invest more into with this particular sponsor. Okay, number 3, understand where you are at in the capital stack. The speak pipe question asked about, the investors weren't first in line. Well, no, you're not first in line if you're the equity investor. The first in line is the mortgage holder, the debt investors. If some property falls in value by 40%, the equity investors are probably wiped out in most cases if that property has to be sold at that time. In fact, if it drops 40 or 50%, if there's another level, a mezzanine debt or a preferred equity level, they're probably wiped out too. Because first in line is the debt holders. That's why debt investing is less risky than equity investing. As a general rule, you're going to make less money too investing in the debt, but you definitely have less risk. So understand where you're at in the capital stack. If you're an equity investor, you're in the riskiest position. If things go well, you're going to make the most money of anybody else. But if they don't go well, you're most likely to be wiped out. And fourth is understand the leverage used by the syndicator or fund manager. How much leverage are they using? How much of it is variable? Is there preferred equity or mezzanine debt too? Does anyone have a call option that they could exercise that could give you problems? Those are the sorts of questions you want to ask when you're getting into these investments. Once you're in them, some of them provide some liquidity, but most of them, you're in them for 5 or 10 years. You're locked in. You're along for the ride. So after the initial due diligence period, you're collecting mailbox money, but no, there's nothing you can do when things are going bad. You're just along for the ride, and it might be a few years before you find out what your overall return was. So the bottom line is real estate investments can and do go to zero. That's one reason why private real estate investors generally must be accredited investors. Right? And, so if both of those accredited investor requirements don't apply to you, if you can't evaluate these on your own without the assistance of others, or if you can't lose all of your money going into the investment, no matter how much FOMO you feel looking at projected or even actual returns, or how much you want to feel sophisticated or that you're playing with the big boys, these are not for you. Okay? Risk is real. Investing is much more about risk control than it is about returns. Hope that's helpful. And obviously, lots of us make mistakes in investing. Don't beat yourself up about it. Learn from it. Move forward. And hopefully this deal gets turned around. They're certainly working very hard trying to do it. And hopefully they can get some or even a good chunk of our equity back out of the deal. But I've certainly braced myself for 100% loss of equity in that deal.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.